Moving on to our next presenter today, I'm very pleased to introduce Al Bedwell. He leads LMC Automotive's global research in the pivotal area of drivetrain and e-mobility trends. With more than 25 years of forecasting experience in the sector, Al is now positioned as a highly respected commentator on a range of vital issues, including conventional ICE evolution, the future of the diesel sector, and the roadmap to a hybrid and EV light vehicle fleet. Welcome, Al. Thank you very much.
Yeah, I'm going to just update us today on the what's going on in the automotive sector, the light vehicle sector, that is. And we've had a lot of disruption recently, of course, as everyone knows. So I'm just going to bring us up to date where we are on that, and then just move on then to talk about electrification, which is my area really of expertise, if you like, and particularly in what's happening with the battery electric vehicle sector. Let's just see where we are as regards disruption to global automotive production. So this slide rather simplistically reminds us of the problems that the auto industry has faced through 2021. There were multiple disruptive events like the Renesas fire, Texas bad weather, Japan earthquakes, a Suez Canal blockage, of course, COVID, et cetera, et cetera. When you line them all up like this, it really does reinforce if you like, the layers of disruption that undermined supply chains and auto production last year. So with all that in mind, surely 2022 couldn't be as bad as 2021 was. So here I extended the chart here. The shaded cells indicate, what's happened in 2022 so far. And just looking at them, it's pretty clear, in fact, that 2022 hasn't started well and really isn't progressing that well either. We've had truck driver strikes in North America, of course, war in Ukraine, COVID lockdowns in China, and an earthquake in Japan. And we're only 2/3 of the way into the year, so it's not looking great even now. And this slide, I think, really highlights the unsettled nature of the business environment right now in the automotive sector. And it emphasizes that the high level of risks that are associated with any automotive forecast at the moment. So, beware when you're looking ahead in this sector for sure. So let's take a look at these key disruptive events. The graph on the left there highlights it quite nicely. The mid-year surge in COVID cases in China and importantly, the lockdown response had a direct impact on domestic auto assembly in China, but also hit the wider supply chain and import-export logistics. That principally affected Japanese and Korean auto assemblers, but component delivery delays and bottlenecks have appeared elsewhere in the world. The lockdowns have been successful in sharply reducing cases, but outbreaks have returned. So the risk of further disruption from that area certainly does linger. And just in the last few days, we've seen lockdown in Chengdu with immediate impact on the output of OEMs, including Volvo. Turning to the impact of the Ukraine war on the auto industry, the importance of Russia and Ukraine as suppliers of raw materials, energy and finished components like wiring harnesses is clearly having a disruptive effect. The graph illustrates the impact that this conflict has had on commodity prices. I've selected palladium, not just because it's key for the auto industry, but also because Russia has a 40% share of global supply of that particular element. Of course, Russia is a big oil and gas supplier, but it's also an important supplier of nickel, cobalt and aluminium, all of which are important for vehicle manufacturing. And after an initial price spike, which coincided with the invasion, prices have come off their peaks. That's good news, but it highlights volatility in the environment. And of course, some of the price falls relate to general fears of economic slowdown now. And turning to the supply of semiconductors, which has been the overwhelming supply side issue for the auto industry over the last few years. The chart on the right there shows the latest lead time development, and it paints a pretty bleak picture. Although we have to say the pace of the increase in lead times certainly slowed in the first half of this year. But feedback from our customers and our tracking of the issue generally indicates that semiconductor supply, although still volatile, is improving, has improved. But there's no doubt the situation is not normal yet, and we continue to regularly hear of production losses due to chip shortages. In 2021, the disruptions that I mentioned there and showed in that first diagram were estimated to account for over 10 million units of lost light vehicle production globally, compared with what we would have seen in a benchmark, or if you like, in a normal year. So, pretty significant. Looking at the disruptive inputs by type in 2022, the chart on the left shows our estimate of the splits through the year. And we can see that still the chip supply, which is in the mint green color, remains a significant disruptor, though not as dominant as it was in Q1 of this year or in 2021 for that matter. We do expect the supply of chips to continue to improve. In part, that's because as demand slows for items like laptops, as the spike in demand from remote working subsides, competition for chip capacity outside of the auto sector is falling and should continue to fall. In addition, OEMs are just now better prepared, while there's also diversion of supply away from Russia, which has helped a little bit to reduce disruption elsewhere. So despite that, the disruptive effect of COVID lockdowns in China, the impact of the Ukraine war, either direct or in the form of missing components or more indirect through increased energy or material prices, continues to be felt. And combining all of this all of this together adds up yet more layers of vulnerability to the automotive supply chain. The other chart, the one on the right there, highlights the disruption impact by OEM. We can see that European OEMs have not fared well during this time, being hit hard by the effects of the Ukraine war and also by the volatility of the chip supply in particular. So here we see the ongoing impact of disruption on light vehicle production in 2022. This year, the situation is improving over 2021, but that's really mainly because China is managing the supply side better than other major car producing regions, enabling swift recovery after COVID lockdowns. Chip supply is gradually recovering, as I've mentioned, but it remains a headwind, and outside of China in particular, problems do persist. The second half of the year is looking better than the first half in terms of lost production, but really what recovery we are seeing is, as I mentioned, is really centered on China and centered on the second half of this year. You can see that the expected impact on China in Q3 and Q4 of this year is considerably lower than that we expect in Europe or in North America, in fact, less than half. But despite that improvement, we still expect to see a loss of around 7.5 million units of light vehicle output this year, compared with that benchmark year, which you could say would be 2019, for instance, before any of these major events happened. And we do see the risk of bigger shock events remaining quite high. Looking ahead, we see a complex picture of continued fallout in supply side disruption, but combined with a cooling global economy and rising inflation. But we do not expect to see the inverted nature of the auto economy to persist. And by that, I mean, that to say that its production has been, rather than demand, has been driving or dictating deliveries for some time now. And we think that that will continue, even though underlying demand is expected to be falling in the near term. Unless we see a catastrophic global collapse in demand, we don't expect demand to be falling away fast enough to close what has become a structural gap between light vehicle production and demand. So we're still seeing that it's the bottleneck is still production rather than demand. There may be some regions where production is squeezed by falling demand, but we don't expect this at a global level. And China's market stimulus will certainly help to support worldwide demand. There's no doubt that the combined impact of disruption since 2029 is severe. At a global level, it won't be until 2024 that light vehicle output reaches the 2019 level. But you can see, in fact, looking at the China bars there, that has largely been achieved already in China. But given the increased level of uncertainty facing the sector in general, we feel obliged to highlight a risk on the downside of the global view there. There just seems to be a consistent or a constant chain of negative events at the moment, and the high risk of that happening, we think, remains elevated. But turning to trends in electrification, so here is a picture to July of this year for major electrification types. Now that's battery electric vehicle in the mint green color, and plug-in hybrids in the light grey, and full hybrids in the dark grey colour and the bars there. And that's for passenger cars and for US light vehicles for those three major markets and regions. So overall growth in the battery electric vehicle sector, which is what I'm going to focus on for this presentation, remains positive. But there are, really significant regional differences in performance. And these three charts are to the same scale, so that gives you an idea globally what's happening. The BEV share in Europe actually hasn't grown since January of this year. And year-on-year sales to July up 30% over the same period in 2021, but no growth since the beginning of the year in terms of share. So that's interesting. US BEV growth reacted to more product coming onto the market from the start of last year, and sales have more than doubled since that time, after steady, if somewhat maybe unspectacular growth, but moving in the right direction and growing pretty linearly. Interestingly, at the start of last year, Europe and China had similar share of battery electric vehicles among their passenger car sales, but of course China has just raced away, moving well ahead of Europe, with BEV share in China now actually double that we see in Europe. And BEV remains overall by far the most popular of these technologies globally, pretty much due to the boom that we're seeing in China. And you can really see on that right-hand chart there how far ahead battery electric vehicle sales are compared to other types. Globally, battery electric vehicle share of car, including North America light truck, has reached an impressive 9% of total global sales so far this year, with actually more than 1 in 10 vehicles globally being sold with a battery electric powertrain in June of this year, which was the peak so far. Since overtaking full hybrid as the most popular electrified powertrain in mid-2021, BEV has opened up a significant gap, and that's largely due to what's happening in China. And so far this year, we've seen 3.6 million battery electric vehicles sold, compared with 2 million in the same period last year. And that's growth of 80%, while total volumes, if you like, total light vehicle volume, sales volumes, impacted by the delivery and production disruption that we mentioned earlier, actually fell by 6% in the same period. So really, if there's a good story here, then it's on the battery electric vehicle side, not the overall vehicle production side. But can we really call it a global battery electric vehicle boom yet? If you remove China from the equation, battery electric vehicle for the rest of the world is around 5% penetration, and that's 13 years after Nissan introduced its somewhat groundbreaking Leaf model. So despite the tremendous focus on BEV at the moment, and honestly, our clients, all they want to talk about is battery electric vehicles. No one wants to talk about ICE so much these days. We shouldn't lose sight of the fact that outside of China, at least, BEV remains quite a niche player in most markets, with ICE and ICE hybrid continuing to actually dominate very strongly. Plug-in hybrid share of sales within China is about the same as it is globally, but the full hybrid segment in China remains quite underdeveloped by global standards, though it's starting to show more signs of growth, helped by supporting policies from government and more domestic product as well. So focusing on Europe. So Europe is generally seen as a high growth region for BEVs, but as we saw, the dynamism of the market has really cooled so far in 2022. But not only that, but there is a huge spectrum of outcomes regarding the penetration of battery electric vehicles, across car markets. The vertical bars in this chart show the situation by market for the first half of the year. And there are some large markets with very low battery electric vehicle sales. I mean, I'd highlight Italy and Spain in that category, quite far over to the right-hand side of this diagram. Of course, there are other markets strongly embracing the technology, with those tending to be in the northern part of the region. But the first half 2022 performance compared with the second half of last year, so not year on year, but comparing with the last half of last year, actually shows negative growth in most cases, and that's indicated by the diamond, the mint-coloured diamond on that chart. Year-on-year growth was positive in most cases, but it isn't spectacular, just averaging 30%, as we saw earlier, and compared to what's going on in China, for instance, that's pretty poor growth. So any car makers wanting to enter the European BEV market should be cautious about where they target. Norway seems to be an obvious target, with 80% penetration or so of battery electric vehicles, but it's a small car market of only 200,000 units or so, and it's could now be approaching, it's not that far off saturation, in fact, of electrification. The reasons for the low growth across the region this year revolve around CO2 targets, which were strong drivers over the last couple of years, but now remain weak until 2030. Supply constraints, of course, BEVs orders might look good, but they can't be built in many cases. And OEMs wishing to maximize profits by perhaps selling high margin combustion cars. We've got patchy infrastructure, of course. It's developing, but it's still patchy. And I think the other thing is price inflation among battery electric vehicles, which is impacting the purchase and lease cost of battery electric vehicle cars. Lease rates are really climbing, certainly in the UK. I was looking the other day and I noticed that a typical VW ID4 lease price for a relatively low monthly annual mileage allowance in the UK, it could be over £900 a month. That's not unusual, and that's 7,200 RMB. So, really rather expensive at the moment. Interestingly, European diesel car market has stabilized so far this year. At the end of 2021, it looked like battery electric vehicles would overtake diesel and remain ahead, but that just hasn't happened. I mean, it will do sooner or later. Zero emission policy dictates that it must. It was thought that high ICE or combustion car fuel prices would accelerate the trend to battery electric vehicle. That just hasn't happened. In fact, people may be wary of high electricity prices for charging BEVs as they are of high diesel and gasoline prices. And of course, the driving range combustion cars still remains attractive for those looking to do long distances. Looking to the medium term battery electric vehicle market, we see continued steady growth, although this year we see sub 30% growth in battery electric vehicle demand, much lower than seen in 2020 or 2021. 2023 should see a stronger outcome with growth of about 50% as more models enter the market, supply disruption improves, and charging infrastructure investment continues, to reassure people that they can complete longer journeys by battery electric vehicle without too much inconvenience. We're not there yet, but it's getting better. Share-wise, we see battery electric vehicle penetration in the region at 13% of the market this year and 18% of the market next year. And I've actually included light commercial vehicles in this chart, which is the grey part. And that market's starting to become significant. 100,000 sales this year, and we expect about 180,000 next year. So starting to move as well. Looking further out, our forecast for battery electric vehicle is broadly aligned with the EU CO2 emissions target, but that will also result in non-EU markets in the region seeing strong growth in BEV share as actually, combustion car model lines are deleted over time and simply become unavailable. However, recent market trends, general market risks, as well as risks specific to the BEV sector did lead us to downgrade the outlook for the second quarter update of our forecast this year. At present, we see no viable alternative to BEV for meeting the region's aggressive ZEV target. I mean, it looks like there will be a policy need to be a 100% ZEV in 2035. Fuel cell cars could achieve the same outcome, of course, but the trajectory of OEM and major component supplier investment makes this look very unlikely in the light vehicle sector in Europe at the moment. But one possible problem with the near total focus on BEV is that it creates huge growth in demand for certain critical raw materials rather than spreading the requirement across different technologies. And that raises potential supply constraints, especially where lithium, for instance, is concerned. And our modelling does indicate a significant risk of a lithium deficit in the medium term in Europe. Assuming that the ZEV targets are confirmed and are rigid, so that could negatively impact top-line car sales. If you just can't build enough battery electric vehicles or they remain too expensive, then that could impact on the overall car market top line. Well, turning to the USA, I showed that the USA battery electric vehicle market had been rising steadily since the middle of 2021. Significant growth in BEV model availability, which the chart on the left there shows, has been one key driver, and that trend will continue with pickup and van body styles being a notable part of the expansion over the coming years, as well as, of course, lots of SUV types as well. And although it's a fledgling market so far, the BEV light truck area will see strong growth, and it's starting to happen now. So to July of this year, 16,000 battery electric vehicle pickups and vans have been delivered in the US, with 4,500 of them being Ford's F-150 Lightning and 3,700 being Rivian's R1T model. So that sector is certainly perhaps the fastest growing at the moment, although still small by compared with the car segment. We finally have resolution to the issue of ongoing government support for the transition to sustainable mobility in the USA. The Inflation Reduction Act, IRA, if you like, extends the plug-in credit system well into the future, which sounds great. Sales caps will be removed from January the 1st, 2023, enabling the likes of GM and Tesla, who'd used up all their quota, to benefit once again from direct fiscal support for vehicle sales. Sounds great. However, there are many strings attached, and a clear focus on domestic sourcing in order to be eligible for credits is a key aspect of this. And in fact, we aren't really aware of any other major market plug-in incentive scheme that places such rigorous conditions on material sourcing. And while such value chains are being built up in the US, some OEMs are going to find that selling plug-in vehicles, and we expect some certainly, smaller or lower value BEVs from some OEMs, like Hyundai, Kia, for instance, will probably be withdrawn from sale as they just become uneconomical without any kind of incentives, direct incentives to make them more attractive. Top end of the BEV market is not dependent on incentives, so that's going to be unaffected by this. And we're currently assessing the impact on the market. The initial view, though, is that the BEV top line forecast may be reduced, at least for the medium term, but the impact will vary an awful lot depending on the individual OEM. But car makers looking only to import are reconsidering their strategies. BYD, for example, says it will now probably focus on Europe and not the USA. So here is our USA battery electric vehicle outlook, and it was formulated prior to the publication of the IRA. Many of the outcomes that would lead to the optimistic forecast are still relevant, though. But the base case we think is likely to be trimmed somewhat, at least over the next 5 years or more, as car makers work to develop local sourcing of battery components and critical materials. And that will not be a simple or quick process, with many currently being very interlinked with Asian suppliers for those items. And turning to China, share-wise, China's NEV market and BEV market in particular continues to make rapid progress, with battery electric car wholesales making up about a fifth of all car sales since March of this year, and NEV, which is essentially battery electric vehicles plus plug-in hybrids, plus a very small number of fuel cells and extended range electric vehicles. But that's exceeding a quarter of total wholesales since April of this year. It seems that during the lockdowns in April, for instance, NEV output was preserved to a greater extent than the market overall, and hence the share stayed high then even, despite the fact that Tesla, for example, lost up to 10,000 units of output by the end of April. Output has generally bounced back very quickly from those sort of lockdowns, reaching, in the case of battery electric vehicles, record levels in June and July. And that was despite Tesla sales falling by 2/3 in July compared with June, because they implemented a plant upgrade in their Shanghai plant to take annual capacity up to about 1 million units. I think the ability to prevent COVID spreading while keeping up output will determine what happens in the remainder of the year. But our analysts in Shanghai remain cautiously optimistic in that area. I showed this chart actually back in May, and at that time our base case for China NEV sales in 2022 was 5 million units, which was the same as what CAM, the China's Automotive Manufacturers Association, was saying until quite recently. But with 3 million NEVs sold to July of this year, and Tesla's plant upgrade being completed last month, that now looks very conservative. And in May, we did suspect that the market could really boom after lockdown, and showed an alternative optimistic forecast on the right. You can see that right bar. The underlying drivers of growth remain in place despite headwinds like some increase on car costs due to battery price inflation. And as we see, sales have boomed in recent months. So currently we expect that 4.7 million battery electric vehicles will be sold this year in China. That's passenger vehicles, and that's growth of 80% over 2021. So going much quicker than Europe, for instance. And aside from booming demand for battery electric vehicles, plug-in hybrids, driven by strong demand for BYD's products in particular, are also doing really well. And adding them to the battery electric vehicle figure gives a figure of 6.1 million NEV wholesales in China this year, which is our current forecast, which is in fact exceeds slightly the optimistic forecast that we showed in May. So I think that just does show the difficulty of forecasting at the moment, plus just how far the progress in China has exceeded not only our expectations, but also, other forecasters as well. Interesting points as regards OEMs and technologies include the success of Ito, for instance, which cooperates with Huawei and is performing well in the market. On the flip side, NIO is doing a bit less well than expected, and BYD is booming, accounting for a third of total NEV sales. The range extender battery electric vehicles are entering the market, offered by brands including Neta, Nutrion, and Chang'an. This technology that's really kind of failed to thrive elsewhere. We've almost written it off in Europe and the US, but it's growing in China, perhaps because a smaller and cheaper battery pack can be used than in a regular battery electric vehicle. Full hybrids from domestic brands are gaining acceptance, taking market share from established players in that segment, such as Honda. And finally, BEV exports from China are growing. Of course, we know that Tesla is an export hub for China, going to Europe and to other parts of Asia in particular, but also, other OEMs like BMW and brands like Dacia are now exporting significantly from China as well. It could appear, of course, that the NEV sector in China is therefore overheating. It's certainly running ahead of the government's roadmap in terms of sales and production. But we are expecting that growth in car sales generally will slow in 2023. Sales will have been pulled forward into this year because of the market stimuli that are currently in operation. And they will expire at the year end. But if the NEV market looks like it could stall because of rising prices or removal of free license plates for PHEVs in Shanghai, for instance, then we would expect some extension or increase in current incentives in order to keep the sector on track. That's the pattern that we've seen in the past, as a diagram here indicates. Every time it looks like things are going a little bit wrong, the government sort of intervened in the NEV side just to make sure that the underlying trend is moving in the right direction. Already we see that the purchase tax exemption for NEVs will be extended into 2023, perhaps to help stimulate NEV sales, which could suffer due to the current tax relief on combustion cars. The draft dual credit policy, which is a big regulatory driver of NEV for 2024 to 2025, is published, and it mentions that the NEV credit percentages should be 28% and 35% respectively, and that's credits that need to be earned from production of those vehicles, and failure to meet those does imply penalties. Results over the next few months will really dictate final policy in the near term, but some ongoing support, I think carrot rather than stick, can be expected for the sector. So we're expecting it to continue to do well. But despite that, we do think the current rate of NEV growth that we've seen is probably a bit unsustainable and unlikely to extend into next year. And we do see lower growth in 2023 in China's NEV market. But looking further out, the recent trajectory for the NEV sector puts it on course to exceed the government's targets laid out in its technical roadmap 2 document of a while back. And that calls for an NEV share of car sales of 40% in 2030 and 50% by 2035, with more than 90% of those being battery electric vehicle. And we think, it certainly looks like those targets will easily be met. And of course, we've mentioned the dual credit policy, which is another key driver as well. We are expecting that supply issues around some battery raw materials, as I've mentioned, could derail efforts to reduce battery electric vehicle costs further and really make long-range BEVs truly affordable for the masses. But China really is better protected than most to overcome this issue, and it's already doing it, in fact. And if the affordability issue is contained, we could easily see a China BEV market of 10 million units by 2025, rather than the 7.7 million that we currently indicate in our base forecast. We think established groups will make up the top 10 OEMs in 2025. We don't expect that any of the recent startups will be able to break into that sector in that time frame. VW probably will resolve eventually their software issues, but that seems to be a very difficult area for them, and it's critical for success in the China BEV market, where the consumer is very demanding in that area. And if they can't get it to work effectively, then BYD or Tesla are well placed to actually take the number one spot in the middle of this decade. And BYD in particular is offering really rather attractive and affordable battery electric vehicles, and it has big targets. It wants to sell 4 million NEVs in 2023 in China, with at least half of those being battery electric vehicles. So, very aggressive targets, but actually it's got the product to back that up. Also, we see sub-brands of established groups doing better than expected. I mean, Ion from GAC is a good example of that one. And then just to summarize globally what's happening in the segment, our long-term forecast sees China and Europe dominating global battery electric vehicle demand, with European and Chinese volumes similar by forecast end, but a much stronger upside risk to the China forecast than to the Europe forecast. So we could really see China being, not necessarily dominant, but considerably larger than Europe by that time. And by mid next decade, BEV sales globally we see accounting for more than half of global light vehicle demand, with an upside risk on that primarily due to China. But in fact, pure combustion engines, still remain important, with more than a quarter of all sales at that time in our forecast. Not all markets will be ready to electrify, even in the middle of the next decade. And finally, turning to sourcing, last year, Asia Pacific produced about two-thirds of the world's battery electric light vehicles, with China in turn being the source of 90% of that two-thirds. Korea was next in the Asia Pacific region with 250,000 battery electric vehicles made, and Japan built just 40,000 BEVs last year. But we think the Asia Pacific region will remain the largest producer of light vehicle BEVs this decade, but its importance will fall as much of the growth elsewhere will start to be locally sourced. Europe and more recently Japan repurposing combustion car plants and engine plants to become battery electric vehicle or battery plants, while the USA currently importing non-US BEV brands will increasingly see onshoring of European and Asian branded BEVs, accelerated, of course, by the Inflation Reduction Act. Battery cell production will follow BEV production. So over this time period of 7 years, the Asia Pacific region, we think, will fall from supplying that two-thirds that I mentioned to just about a half of global light vehicle battery electric vehicles. So it still remains dominant to some degree. Volume-wise, North America reaches 5 million units of output by 2029. And Europe's at 10 million, and Asia Pacific gets to about 15 million, broadly speaking. And those figures were put together before the release of the US IRA, and hence there's now an upside risk to North American production share. It could move a bit quicker than we show here. So with that, I will finish and hand over.
Brilliant. Well, thank you, Al. I mean, it's certainly extraordinary the scale and pace at which the automotive industry is transforming at the moment. So thank you for the very insightful presentation.